All right, let's break down the Q1 earnings for Simply Good Foods. On the surface, the numbers looked a little messy, but the way the market reacted, well, that tells a really fascinating story about expectations, relief, and a big bet on a second-half comeback.
So this all boils down to one big question. Why on earth did the stock rally so aggressively on what most analysts on the street were calling mixed results? I mean, this was not a blowout quarter by any stretch of the imagination. So what did investors see that got them so excited?
And just look at the sheer force of this move. The stock closed the day before under 20 bucks. Then, after the earnings dropped pre-market, it just skyrocketed to almost $21.70. That's a nearly 12% jump before the opening bell. It completely blew past what the options market was even pricing in. That's not just a positive reaction, my friends. That is a massive sigh of relief from the entire market.
Okay, so let's get into the actual numbers. Because when you start to peel back the layers here, you find what we call a low-quality beat. The headline numbers look good, but there's some real weakness hiding just underneath the surface.
So here's the quick snapshot. Adjusted EPS? 39 cents. The street wanted 36, so that's a nice beat. Revenue, $340 million, also just a hair ahead of what everyone was expecting. But take a look at that gross margin number. That right there is where the trouble was hiding.
So let's talk about this EPS beat, because it was a really big deal. See, the company actually missed earnings in the prior quarter, so investors were pretty nervous. Delivering a 3-cent beat and 8.3% surprise, that was a critical signal that management had steadied the ship and could actually deliver on their promises.
But here's the other side of that coin, and boy, is it a big one. Gross margin fell by a staggering 590 basis points from last year. To put that in perspective, that's a 5.9 percentage point drop. It was driven by costs for things like cocoa going through the roof, plus the impact of tariffs. This severe margin crunch was the real problem in the quarter, and it's why that beat was considered low quality.
Now, right in the middle of all this margin pressure, management sent another huge signal. They announced a brand new $200 million share buyback program. When a company does that, when they aggressively buy back their own stock, they're shouting two things to the market. One, we think our stock is cheap, and two, we're really confident in our future cash flow.
So how did they explain it? How do you have good EPS but bad margins? Well, they pitched a very compelling story, and it's a classic, a tale of two halves. They basically asked investors to just look past all the current weakness and buy into a major recovery they see coming in the back half of the year.
And here it is, straight from the CEO. This one sentence, this captures the entire narrative that investors clearly bought into hook, line, and sinker. It's a direct promise that all this pain is temporary and that better days are right around the corner. That forward-looking confidence was exactly what the market was desperate to hear.
And this is the roadmap for how they plan to get there. The first half of the year, they're getting hit with headwinds, cost inflation, tough comparisons to last year, you name it. But in the second half, they expect that to flip to tailwinds. Price increases will finally kick in, big productivity projects will start paying off, and some of those key input costs should start to come down. That's the plan.
Now, the story gets even more interesting when you dig into the brands themselves, because this company is really operating at two totally different speeds. It's like you've got these high-octane growth engines on one side, and then a legacy brand that's kind of acting as a drag on the other.
And this chart just makes it crystal clear, doesn't it? The growth brands, Quest and the newly acquired OWYN, now make up a whopping 71% of the company's total sales. The legacy Atkins brand, it's down to just 29%. And this is a huge point. The problems at Atkins, while they're still there, just matter a whole lot less to the total company now. The growth engine is officially in the driver's seat. And the performance gap is just stark. You've got Quest and OWYN delivering double-digit consumption growth, grabbing more shelf space. Quest alone was up 12%. And then you have Atkins where consumption fell 19%. Now, a lot of that was on purpose. The company is strategically ditching less productive shelf space to make room for its faster-growing brands. It's what you'd call a managed decline. So, let's put it all together. What does all this mean for the next quarter and beyond? What should you be watching for? Here's our take.
Okay, here are the 3 key things you really need to keep an eye on. First, and most importantly, does that gross margin number actually start to improve in Q2 and Q3 like they promised? Second, does the slide in the Atkins brand start to level off? And third, how aggressive is the company with those share buybacks? These are the proof points for management's story.
But, and this is so important to remember, management was very, very clear. The recovery does not start next quarter. They're guiding for Q2 to be the weakest quarter of the entire year.
They're expecting sales to fall and for gross margin to still be down by about 300 basis points. The turnaround is an H2 story, period.
So what's our prediction for the stock? Well, our view is that it's likely going to be range-bound for a little while. That big, exciting relief rally, that's already happened. Now, the market is going to enter a show-me phase. It's going to sit back and wait for the hard data in the second half of the year to prove that the margin recovery is for real.
And for that reason, we're rating the stock market perform. Look, the company did a great job convincing the market that the worst is over, and they laid out a credible path to recovery. But with guidance just reaffirmed, not raised, and the weakest quarter of the year still ahead of us, we really need to see that tangible proof before we can get any more bullish.
And of course, just a final reminder that this analysis is for informational purposes only. This is not financial advice.